Hey everyone, welcome back to Corporate Decoder. Today, MZYX Acquisition Corp just filed its quarterly report, and I am seeing a very interesting cash situation unfold. Quick note, this is not financial advice, just my take on public filings for educational purposes. This company is basically a blank check company waiting to buy another business, and their latest filing shows a ton of cash sitting in a special trust account. So MZYX Acquisition Corp is a company that was formed to find and merge with another business. Think of them as a SPAC, a special purpose acquisition company. They raise money from investors and then have a set amount of time to find a business to buy. If they don't find one, the money goes back to the investors. This report covers the first 3 months of 2026, ending on the 31st of March. The company itself was formed in October 2025, so it is quite new. Most of their activity so far has been getting ready for their big event, which is their initial public offering or IPO. Now let's dive into the financials. The balance sheet shows us what the company owns and owes at a specific point in time. This is where it gets interesting. As of the 31st of March 2026, MZYX had $300,955,500 in an account called the Trust Account. This account is where they put the money raised from their IPO. They can only use this money to buy another company. At the end of the 31st of December 2025, this account had nothing in it, which makes sense since the IPO happened later. They also have some cash outside of the trust account. As of the 31st of March 2026, they had over $1.2 million in cash. This is separate from the trust account money and is used for everyday operating expenses. On the liability side, they have a $12,780,000 deferred underwriting fee. This is basically money that will be paid to the investment banks who helped them with their IPO, but only after they complete a business combination. This part is crucial for SPACs. It shows Class A ordinary shares that are subject to redemption. This means that the investors who bought these shares in the IPO can choose to get their money back if a business combination isn't completed. As of the 31st of March 2026, these shares are valued at over $300 million, while back in December they were worth nothing. This reflects the IPO happening and the money being placed in the trust. The additional paid-in capital section shows a big jump from $24,250 in December to $0 in March. This is because of how they account for the IPO. The money raised from selling shares is split between the par value of the shares and the additional paid-in capital. Their accumulated deficit is quite large, over $11 million by the 31st of March 2026. This is typical for a company in its early stages, as they have incurred expenses for formation and the IPO without generating any operating revenue yet. Now let's look at the statement of operations, which shows how the company performed financially over a period of time. For the 3 months ending the 31st of March 2026, they had formation and operating expenses of about $139,000. These are the costs associated with setting up the company and getting ready for the IPO. The good news is that the money sitting in the trust account earned them over $955,000 in interest income. This income is generated from the safe investments they make with the trust account funds. This all led to a net income of $822,679 for the quarter. It is important to remember this is not operating income from a business, but rather from the interest earned on the cash they have. They also report earnings per S-share for their Class A and Class B shares. For the redeemable class of shares, they had about 11 million weighted average shares outstanding. This resulted in a basic net income per S-share of $0.05 for the redeemable class of shares. The statement of changes in shareholders' deficit shows how the equity section of the balance sheet has changed. At the beginning of the year, December 2025, they had a small shareholders' deficit of just under $15,000. Then, a significant event happened. Private placement proceeds of over $7.2 million were added. This is from the sale of warrants to certain investors before the IPO. There is also an addition of over $2.4 million related to the fair value of public warrants. And then crucially, over $152,000 in offering costs were deducted. These are the expenses related to issuing the shares. The most significant entry here is the remeasurement of over $21 million. This is related to how they are accounting for the class of shares that can be redeemed. Because these shares have a redemption feature, their value is constantly adjusted, and this remeasurement reflects that change. By the end of March 2026, their shareholders' deficit changed dramatically due to these events, ending up at a deficit of over $11 million. This large deficit is largely driven by the accounting treatment of the redeemable shares and the IPO costs. Let's look at the cash flow statement to see where the money is actually coming and going. The net income of $822,679 is listed first. But as we know, Most of this is from interest income. They then subtract the interest earned on the trust account, which is a bit counterintuitive, but it is how they adjust for non-cash items to get to the actual cash generated from operations. Overall, their net cash used in operating activities was about $337,000. This means that their day-to-day operations are costing them money, which is normal for a company pre-business combination. In investing activities, they show a massive outflow of $300 million. This is the money from the IPO that was deposited into the trust account. The financing activities show the flip side of that, with proceeds of $300 million from the issuance of Class A shares as part of the IPO. They also received over $7.2 million from the private placement of warrants. And then about $5.6 million was paid out for offering costs. There is also a non-cash item here, a remeasurement of Class A ordinary shares subject to redemption, totaling $21.7 million. This again relates to the accounting for those redeemable shares. Going into the notes, we learn more about the company's structure and purpose. MZYX was incorporated in the Cayman Islands in October 2025. Its sole purpose is to find a business to combine with. The IPO happened on the 26th of February 2026, where they sold 30 million units at $10 each, raising $300 million. This is where the bulk of their cash came from. The IPO wasn't cheap. Transaction costs were nearly $18.5 million, which included underwriter fees and other offering expenses. A key rule for SPACs is that the business they acquire must be worth at least 80% of the money in the trust account. This is to ensure they don't overpay significantly for a target. This note explains why the redeemable shares are treated so specially in the accounting. Because investors can choose to get their money back, these shares are considered temporary equity. Under the going concern section, the company states that with the funds from the IPO, they believe they have enough working capital to continue operating. They expect to use the money outside the trust account for finding and completing a business combination, and the money within the trust account for the actual purchase. This section details the accounting rules they follow. They are an emerging growth company and are taking advantage of certain exemptions from reporting requirements. They explain how they account for offering costs, allocating them to shares subject to redemption and warrants. This is a very detailed explanation of how they account for those redeemable shares. It highlights that these shares are presented as temporary equity and their value is adjusted as needed. The table here clearly shows how the $300 million in gross proceeds from the IPO minus warrant allocations and share issuance costs, plus the remeasurement adjustment, results in the $300,955,500 value for redeemable Class A shares. This note reiterates the details of the IPO, including the number of units, the price per unit, and the specifics of the Class A shares and warrants included in each unit. Here they detail the private placement of warrants to the sponsor and other investors, which happened at the same time as the IPO. This section covers transactions with related parties, primarily the sponsor. It details the issuance of founder shares and agreements related to them. It also mentions indications of interest for a private investment in public equity transaction in connection with a business combination from companies like Kraken. This is a potential source of additional funding for their future business combination. There was a loan agreement with the sponsor for up to $300,000 for IPO expenses, but it seems none of that was actually drawn. They also have provisions for working capital loans from the sponsor or affiliates, which is pretty standard for SPACs to cover expenses if needed, with the option to convert some into warrants. This covers things like registration rights for certain shareholders and details about the underwriter agreement, including the deferred underwriting discount that will be paid upon a successful business combination. This breaks down the different classes of shares preference Class A and Class B. It highlights that as of the 31st of March 2026, there were no preference shares issued, and no class of shares issued outside of those related to the IPO and subject to redemption. The Class B shares are mostly held by the sponsor and have specific voting rights. This is a key section for understanding the company's structure. It details the public warrants and private placement warrants. They can be exercised to buy class of shares at $11.5. A critical point is that these warrants cannot be exercised until 30 days after the business combination is complete. There is also a provision that allows the company to redeem the warrants if the class of share price reaches $18 per share for a certain period. This is a mechanism to force warrant holders to exercise or lose their value. This note confirms that MZYX operates in a single reportable segment. As a SPAC, it is focused on one main goal, finding a merger target. This section discusses how they value certain financial instruments. The $300 million in trust is considered level 1 fair value, meaning it is very straightforward. The warrants, however, are valued using the Black-Scholes model, which falls under level 3, meaning it uses unobservable inputs and assumptions. This note tells us about events that happened after the 31st of March 2026. Crucially, it mentions that the underwriters did not exercise the remaining portion of their over-allotment option, leading to the forfeiture of 3,750 Class B shares in April. This section is management's narrative explaining the financial results. They reiterate that they are a blank check company and that their main goal is to complete a business combination. They confirm they have no operating revenues yet and that their net income comes from interest earned on the trust account. The expenses are for general corporate purposes and IPO related costs. This part explains how they have enough money to operate. The IPO proceeds are split between the trust account for a future acquisition and cash outside to cover operational costs. They mention the possibility of working capital loans if needed. They state they have no off-balance sheet arrangements, which is straightforward for a company at this stage. They do not have any long-term debt or lease obligations. They also note that as of the 31st of March 2026, there were no critical accounting estimates. This means their accounting is relatively simple at this point. As a smaller reporting company, they are not required to provide detailed market risk disclosures, which is common for SPACs. They report that their disclosure controls and procedures are effective, meaning they have systems in place to ensure that important information is reported on time. Since they are a smaller reporting company, they are not required to list new risk factors here. They refer back to their prospectus for the risks involved. This section details the IPO and the private placement of warrants, reiterating the amounts raised and how the funds are being used. Specifically, $300 million went into the trust account. This part lists all the attached documents, including certifications from their CEO and CFO, which are standard requirements. Finally, the report is signed by the CEO and CFO Benjamin Zucker. So, what is the story here? MZYX Acquisition Corp is in the very early stages of being a public company. They've successfully completed their IPO and have a large amount of cash in trust, ready to find a target company. The company's financial health at this point is less about business operations and more about the careful accounting of funds raised and the potential for future dilution from warrants. The significant net income is purely from interest on their trust account, not from running a business. The biggest item to watch for investors will be their success in finding and completing a good business combination within their deadline. If they don't, the money in trust is meant to go back to the public shareholders. The risk I am watching is their ability to find a suitable acquisition target, as many SPACs struggle to do so within their timeframe. What I am actually looking for is the announcement of a definitive merger agreement. Alright, that is my take on MZYX Acquisition Corp. Its latest filing. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.